Good evening, ladies and gentlemen. I hope you had a good day and welcome once again to yet another Mango Spaces session. Today, we will be discussing on managing KRA audit. And while at it, we will look at what to do before, what to do during, and what to do after you've gone through a KRA audit. My name is Joe Moniki. I will be the moderator of our session today, and I'm a tax specialist. With us, we have two ladies who will be our panelists today, and I will allow them to introduce themselves, what they do, and their area of tax expertise. We'll start with Anne, then Terry. Anne?
Thank you, Joe. I am Mabondu Anne. I'm a senior tax manager at Deloitte, and I'm glad to be here to share on the best way to manage a KRA audit. Thank you.
Thank you, Anne. Terry?
My name is Terry Muli. I'm an international tax and transfer pricing expert. I've worked in this space for the last 10 years. It's a pleasure to be here this evening to talk about KRA audits across the spectrum, domestic taxes and cross-border taxes.
We will start from understanding what really is a tax audit, and I will pass that question to Anne. So, Anne, you can start by explaining to us in brief what Kenya Revenue Authority audit entails and the legal framework where it's enshrined under our tax laws.
The audit by the KRA is part of their mandate under the legal legislation. They have the powers under the Tax Procedures Act to examine records of a taxpayer and also to confirm that the taxes that were due were paid. It is part of their duty. No one should feel like they are being victimized when KRA says they want to conduct an audit. It is good to collaborate and negotiate with them at the point where it is necessary. So as taxpayers, when are we engaging with KRA on these issues of audit, it's always good to remember three critical aspects. The first one being documentation. Of course, KRA will come in to request for documentation. Then in terms of data, it's important also to ensure that the data that you share with KRA is of high quality and also there's integrity. What I mean by quality is that it's easy to work with, can lead to reasonable results. Yeah. Then also in terms of integrity, it's about being consistent. What you say today about an issue, let it be the same thing you say the following day. They'll be able to trust what you're telling them and also give them a good basis of reviewing your records. Finally, also, when you're dealing with KRA, another key aspect to look out for is in terms of statutory timelines. These timelines are very key because if you miss on any, there might be repercussions which might not be very good for the taxpayer. So they're not just procedural technicalities. It is good to observe them. So that is in a nutshell what would entail an audit. Just an examination of your record by KRA to confirm you paid the right taxes and that your books speak to the tax return that you filed.
Thank you, Anne, for setting that good introduction on what KRA audits entail and knowing that they are enshrined under the Tax Procedures Act. So with that in mind, and the question to Terry is, in your opinion, whether you think KRA has in the recent past intensified the frequency with which it has been conducting this kind of a tax audit and investigations. Terry?
Yes, I would say there's definitely been an increase in the frequency with which the Kenya Revenue Authority has been conducting audits, and this cuts across various tax areas, so both the Customs Authority and the Domestic Tax Authority. I would say this is driven by basically the macroeconomic environment when it comes to the expansion of the economy, the introduction of new sectors, the introduction of new complexities in businesses, the digitalization of the economy as well, but also from a tax authority perspective, just the need to collect more in the revenue pressure from a fiscal perspective. So Joe, yes, the frequency has definitely increased, and one key telling factor is the decisions or judgments that are being issued and the rate at which these are being issued as well by the tribunal and higher courts. So it definitely would be something to just have in mind and keep in mind as we operate in the country as taxpayers and individuals.
My overriding question to that, Terry, would be, historically, people who are in business and maybe operating their business as a sole proprietorship premised under their personal PIN, there's been perception that running your business as a sole proprietorship using your personal KRA PIN, if you are operating anonymously, So question to you is whether this is still the case or whether KRA is still now able to catch up with the persons, especially people working as consultants using their personal PINs, whether KRA is now able to catch up with them and also carry out audits on their business operations.
Yes, definitely, Joe. I would say sole proprietorship, which is a very common business channel for individuals conducting different businesses in the country, is definitely under increased scrutiny from the tax authority. The tax authority now has more data on individuals who are conducting business in Kenya. There has been increased compliance requirements from an invoicing perspective, and I would say this is a key driver in terms of visibility from a tax authority standpoint. Even if you're a sole proprietor at this point, you are required to issue an ETIMS compliant invoice, which allows you to actually then link automatically to the Kenya Revenue Authority systems. And therefore, KRA is able to undertake risk-based assessments of the kind of revenue you're turning into your business, as well as the kind of business you're operating, the kind of volumes you're pushing, the kind of sector you're in, and many other factors. So, Joe, I would say as individuals, while previously, yes, there's been a perception that you can operate under the radar, KRA has increasingly been able to look into and net in taxpayers who would fall within that micro or individual taxpayer bracket.
To our listeners who are running SMEs through a sole proprietorship, it's important to take note that there's obvious increased scrutiny based on, as alluded by Terry, the new invoicing mechanisms through ETIMS, the withholding VAT mechanisms. And so KRA is able to get data on your supplies to other maybe bigger institutional taxpayers. So it's important to also take note of that and consider compliance going forward. With that background, I think it's important then now we can look at, from your experience, Anne, you can let us know what are some of the triggers you have seen activating these KRA audits or giving KRA a signal to want to delve deeper into a taxpayer's business operations to just check their level of compliance. And
of course, there are a number of factors that come into play when it comes to KRA choosing who to audit. But the key one is when a taxpayer fails to comply. So you're consistently not filing your returns by the due dates. You have issues of discrepancies in your tax returns. For instance, in a case where maybe your revenue as per corporate income tax is less than what you have in the value-added tax returns, then again, KRA would want to check more onto why there's this discrepancy. Also, as already alluded in terms of the third-party information, and in this era of iTax platform, ETIMS, it's very easy for KRA to get information from a third party in terms of this one good taxpayer files returns on time, but I check through their suppliers listing, I don't see their suppliers also filing their returns. So KRA can ride on information that is shared by the good taxpayers to also let those who are not filing their returns on time. So KRA will have a good background to go and look for these taxpayers who are not paying their fair share of taxes. Then we've seen a focus mainly on some sectors and some risk-based audits. There could be an issue in an industry where KRA realizes that there's a high level of miscompliance. So there may be then initiate audits for entities that operate within that sectors. Also in cases where maybe a taxpayer has applied for maybe a refund, it could be overpaid taxes or the VAT refunds. Before such refunds are released, you find that most of the time KRA will want to check if there is any underpayment of any other taxes before these amounts are released. Also, in case you be dodging KRA, maybe they're trying to reach you, writing emails, asking a few questions and you're not able to respond on time, that might also raise their eyebrows and target such a taxpayer for audit. Looking at it, it's very critical for taxpayers to remain compliant because, as I said earlier, when you do not at all comply, then you easily be a target for audit by the KRA. And as Terry said earlier, of course, this high requirement in terms of tax revenue targets by the government. So we are seeing a lot of increased audits for both large corporations as well as small corporations. So we can say, as much as there are triggers, we just need to be very ready as taxpayers for an audit any time, because it is a matter of time, and I know KRA will be knocking doors to most of the taxpayers.
Thank you, Anne. So, Terry, a question to you, and you mentioned to us that you are an international tax specialist, and we are still looking at triggers for KRA audits. Maybe you can briefly tell us what triggers KRA audits on international tax level, and by so doing, maybe you'll go slightly without going so much details. Tell us what is transfer pricing and what are some of the triggers for KRA audits under transfer pricing. Terry.
It's important maybe to first start out with explaining what transfer pricing is. So this is basically the setting of prices between related parties. And party can be related to another either through common management, common ownership, common control. And I will respond to this question with a particular focus on companies or entities, which then would have cross-border related parties based in other jurisdictions or based in a preferential tax zone in Kenya. So a very important question, Joe, and I do believe, similar to what Anne has said, a few of those triggers that cut across general tax space would still apply to transfer pricing, starting off with a key one that she spoke about, which is non-compliance. And non-compliance from a transfer pricing point of view starts off with failing to comply with the legislative requirements that mandate a taxpayer who has such dealings or transactions with non-resident entities that would be deemed as related parties to prepare documentation or to support their dealings with related parties through very robust agreements and other supporting records. So that is a very common trigger, similar to what Anne said. But other very specific triggers for transfer pricing audits would be, one, risk-based selection audits. So usually these are at the commissioner's discretion for the most part. They can either be driven by a sector within which a taxpayer is operating, which maybe has been mapped as a high-risk sector for transactions. Usually, this follows either new sectors or new complex transactions within certain sectors. For example, if you talk about the carbon space right now or the digital economy space right now, other very high-risk sectors would follow the size of the economy or the GDP contribution of a sector, like the agricultural sector, where KRA would tend to really focus on companies dealing in commodities, either from an importation or exportation point of view. Again, from a commissioner's discretion point of view, other risks may entail having audited previous taxpayers and identified common transfer mispricing issues, which then would ideally be an indication of what may be happening within a specific industry or sector. Further, it may just be driven by the size of a company. If you're a large taxpayer with many transactions or multiple transactions with non-resident parties, then this would definitely form a basis as well for audit. And lastly, Joe, I'll finish with saying companies that may not be large multinationals may also be subjected to transfer pricing audits driven by where they are incorporated offshore, especially if you're set up in a country that would be considered or perceived as a tax-friendly jurisdiction or as a tax haven or a tax-opaque jurisdiction, or a country that has been grey-listed as having tax policies that are below the usual tax rates or below a certain percentage. So this can be a common trigger as well and does impact startups. So any of us who are on the call who may be founders, startups, would also be subjected to that, especially from a perspective of understanding whether the offshore setup actually is based on substance, whether there is any management or control existing outside the country, or if it's simply a shell company, to test the authenticity of transactions as well, and the arm's length nature. Arm's length nature being if their price is set between these parties, then can you verify that indeed they follow market conditions, or are they overpriced or underpriced, as the case may be. Joe, from a TP perspective, there are others, but I will just summarize those as the key triggers.
Thank you, Terry. That is very detailed enough. I would not want us to go into so much details lest we lose our audience or we bore them with too much tax jargon. So we will pack the issues on the transfer pricing for a bit and go back to the general tax issues on managing revenue authority audits. And the question to Anne is, maybe you can give us an indication on the statutory document retention period in Kenya, and you can entwine that with how far back KRA can require to look into your books. Anne?
Let me start with the latter in terms of how far KRA can go. Of course, the standard period is 5 years. The KRA under the Tax Procedures Act, they are required to go back 5 years from the date of filing the return. That needs to be very clear, because at times people may look at the year of income instead of the year in which the return was filed. So it's very important for taxpayers to know that when you're counting this statute of limitation of 5 years, you know when to begin and where to end, because we actually seen some cases and some ruling on issue of statute of limitation. At times the KRA loses, at times the taxpayer might think they have an argument that KRA went beyond 5 years, but apparently you find KRA was within the 5 years. So it's important to note about the 5 years. Having said that, we also need to know that the 5 years can be extended, and especially where there's evidence that the taxpayer behaved in a manner that can be deemed to be fraudulent or those negligence on the part of the taxpayer. In such a case, then KRA has powers to go beyond 5 years. Of course, they have a department within KRA for investigation, and they'll try in as much as they can be able to get information for period prior to 5 years. So again, we need to be careful as taxpayers in terms of how we present our information. What I said earlier in terms of consistency and data quality, so that there's no one time that KRA may think that there was some fraud or some attempt to maybe taxes, and that was no misrepresentation of facts by the taxpayer. So in terms of the number of years that a taxpayer is required to keep documents, again, this aligns again with the statute of limitation. It should be 5 years. But remember, having said that this can be extended based on the factors that I've stated earlier, then you may be required to have documents for more than 5 years in case now an audit exceeds 5 years. So what you're seeing here is that these two are tied, because for an audit to be completed, there'll be an examination of documentation. So what we advise our taxpayers is to ensure that their information can be availed within the required notice. The information can be physical or in soft copies. Of course, in this era, we're doing a lot of things and saving documents in soft and even in cloud. So just ensure that you have that information available on request, as to hasten the reviews by KRA, and also not to create some mistrust where KRA may think that you're trying to hide some facts about your business. That is what I would say about the information, period of keeping information, and also statute of limitation.
Back to Terry, and the question to you is, at the point when an audit is commencing, normally whether there is any document that taxpayers expect to receive from KRA, and what is the notice period?
Before an audit commences, you would expect to initially receive a formal notification from the Kenya Revenue Authority. Usually this is in form of a letter, which is issued under Section 59 of the Tax Procedures Act. I think Anne touched on that as well. This formal notification letter would then specify the intention of the audit, what key areas would be looked at, what key taxes would be audited, value, if it's value-added tax, withholding tax, corporation tax, pay-as-you-earn. For companies with transfer pricing, then it would also clearly indicate transfer pricing as an area of audit. And this would ideally be the initial indication that you have been selected for an audit or inspection by the Kenya Revenue Authority. The letter as well would indicate the commencement date. To your question about the timelines, it would as well indicate how soon you should produce these records. Usually, and again, depending on the team that is undertaking an audit, a request can have a timeline of anything from 7 days to 14 days. That's the typical timeline. A taxpayer can, of course, immediately engage the Kenya Revenue Authority to seek for extension of time or relief from commencing the audit immediately if certain business circumstances dictate that. But ideally, then the time period would be less than 2 weeks to actually submit these records. Just going back to the importance of having up-to-date documentation in place and not waiting for the tax authority to request for that. And lastly, it would indicate the audit team that is conducting the audit, starting with, of course, office or station or department that is subjecting the company or taxpayer individual to an audit, as well as the contact information.
And from your experience, Terry, maybe you can mention whether you have seen KRA actually agreeing to extend the notice period to commence the audits.
Yes, from experience and again with multiple taxpayers, KRA can be quite amicable to extending the time to produce records as long as, and the caveat here is the taxpayer can clearly indicate the reason for requesting for an extension, and secondly, that the taxpayer can provide a specific date or timeline by when they will provide those records. The other important thing to do is show that you are willing to comply, perhaps ask for a phased provision of records, where you have records in the statute of limitation being 5 years, as Anne explained. If some of the records have been archived or are sitting offshore with maybe your non-resident counterparties, then you can also indicate this to KRA very clearly. So it's important to formally request KRA for an extension, just citing the reasons. But yes, as long as these reasons are reasonable, then the KRA would be willing to extend that. Perhaps the next question would be how long they would be willing to go. We've seen KRA issue extensions for up to a month, but again, this must be tied to justifiable business circumstances that are causing this delay in the provision of records.
Thank you, Terry, for that clarification. Important to note by our audience. No need to panic. If the information is not readily available, you can always seek for an extension and give justifiable reasons. Back to Anne, and we're still on the notification of intention to audit by KRA. What are some of the mistakes that you've seen taxpayers do when they receive this notification to carry out an audit? And
it's good to mention that the taxpayers should always be on the lookout, because again, this notice might be sent through the default iTax email, which could be there's no one who checks on it frequently and they might miss it. So that is one of the mistakes. You find there is no dedicated resource or an employee who frequently checks emails from iTax, because then you can easily miss that. So what you're saying is important to ensure that there's someone who is manning that email address. What I've also seen is that some of the taxpayers just keep quiet. They don't even call KRA just to start engaging. What we need to bear in mind is that when KRA says they want to come and conduct an audit, we should embrace the exercise and collaborate and communicate with them as frequent as possible, because it's a journey that you're starting together. And you want to explain to them exactly how you computed your taxes and how much you paid. Yeah. So it's good to speak to the KRA. This notice always show the office that issued and always have maybe even a mobile phone of whom you can contact an email. It's always good to acknowledge that we have received this and we'll be going to organize ourselves and get back. Also, as Terry said, some taxpayers might fear. There's the fear of KRA by some taxpayers, and they start panicking and wondering, what do I do next? So it's important just to ensure that you review the notice very well to understand it well in terms of the scope, the taxes they are going to be covered, and the kind of documents they require, and also just prepare. And then also it's good to share. If you have a dedicated tax advisor who works with you on tax compliance, it's good also to show them the notice than just keeping it to yourself, so that as a team you can have strategies of how you're going to handle this issue. So it should be seen as a moment to collaborate and speak to KRA, not a moment to panic and start wondering what next. It's just good to get a team that will work through with KRA. Also, what we recommend is that when KRA is on the ground, they have a contact person, the person who helps them manage. Just like we have statutory audit, you'll find within the firm, they have allocated specific people roles to assist the process of the audit. That should be the same for KRA engagements. Ensure that we have people we have allocated to deal with KRA in terms of this audit. So there should be no panic. There should be no keeping quiet. Just be ready and keep the information for them to review.
And you mentioned the issue of engaging a tax advisor. And maybe you can clarify this point, whether it is mandatory to communicate to KRA in writing that you have appointed so and so tax advisor to help you carry out the audit.
Yeah, it would be advisable, and as Terry indicated, at times it could be a risk-based audit, and the issue being reviewed might be a bit technical for the taxpayer to handle, and it would be necessary maybe to be handheld by the tax advisor. At that point, it would be advisable to inform them that I'll be working this through with my tax advisor. And what we've seen from experience is that whenever there's a tax advisor, the discussions take better route, and by the time the audit fieldwork is concluded, you find most of the issues have been able to be clarified and sorted out. At the end of the day, you find you're saving time, you're able to deal with non-issues. You don't only have what really needs to be being escalated. So it's good to have a tax advisor and inform KRA that for this, I will be supported by my advisor. So it is good to onboard a tax advisor.
Back to Terry, and the question for you is, during the audit, maybe from your experience, you can help paint a scenario for us, the different approaches that KRA would apply to carry out these audits, whether it would be purely a physical site audit or some information can still be relayed online through emails or even through online meetings through Teams or through Google Meet. What, from your experience, have you seen as the modalities that KRA would apply to carry out this audit?
The common modalities, and you've put it very well, is initially it's of course a request for records, and these records are typically submitted in electronic copy given the time and age we find ourselves in. But in certain cases, then once these records have been submitted, or if the records are voluminous and they need to be reviewed physically, then the tax authority would actually undertake a physical field audit. This is quite common to have KRA go to a taxpayer's premises and sit there with records, go through the records in detail for a week, a couple of weeks, so that by the end of their exercise or audit, then they would be able to go away having reviewed, maybe not comprehensively, but in great detail, what they intended to audit. So that can be one way through the field audit. In certain audits as well, the tax authority can request to engage the taxpayer once they've done a review of records. Sometimes they will request to have interviews with management or key staff in order to establish clarifications or collate more data or information on the taxpayer. So really, again, Teams, like you've said, Google Meet, these are still avenues through which KRA increasingly engages with taxpayers as well. So it's across different channels, Joe, that a taxpayer can be subjected to the audit in terms of the process itself.
Back to Anne. Assuming that as a taxpayer, we've provided all the information required and the KRA is satisfied, or maybe not satisfied that the information is being provided as required, and the audit is coming to an end, maybe you can paint to us a scenario. What happens at the tail end of the audit? What are the rights of the taxpayer? What should the taxpayer ordinarily expect to receive from KRA and did not receive, whether there's room to request or a push for that to be regularized? And
that's why I think we're calling it managing a KRA audit. So it is upon the taxpayer to ensure that they keep discussions alive with the KRA during the audit process. So then you're able to lay out expectation at every stage. Of course, generally we know that at the end of the audit process, we mainly receive what we call a preliminary findings just from the review of the documentation. Mostly KRA will give a preliminary findings letter. I've heard of scenarios where a taxpayer said that KRA passed by, they stayed for a few weeks, and they have never come back. So then that brings in the question of how are you engaging with these KRA teams? Did you set expectation when they came in terms of how long they're going to be in the field? What to expect from them? It's very important also as a taxpayer to speak to the KRA and request that we need to have documentation to support that actually you guys came around and reviewed a number of documents and these are your findings. So at minimum, we'd expect a letter of preliminary finding, which then of course forms a basis again of discussions, because this is based on what KRA finds at face value. But I know with subsequent clarifications and discussions, most of these issues are either confirmed that maybe there was an underpayment or there's an issue to escalate, or for others, you find they are dropped because, again, the taxpayer is able to explain themselves and KRA gets satisfied. So at minimum, that is what we need to have. Also, we encourage that the way we have interviews and also opening meetings for KRA audit, let the taxpayer and also through the tax advisor ask the KRA that we hold an exit meeting, just to show that we are all comfortable what was requested was provided. Because again, Joe, you also agree with me that of late we have so many cases going to the tax appeals tribunal, and you find the ruling says that maybe the taxpayer never provided or the information, or they didn't pass the burden of proof test. So again, that goes back to how this audit was managed, because if there was proper collaboration, I would expect that most of this information was shared. If there was that goodwill by both the taxpayer and the KRA, then there would be no instance of maybe having so much rulings around a taxpayer failing on the burden of proof. So let's, as I said, embrace the process. We cannot run away from audits. I said again, it's a KRA duty mandate to check on how taxpayers are complying. So as taxpayers, it's just to embrace and work with KRA, speak, show them what you did, negotiate depending on the issue that is on the table, and then make sure there's a good conclusion. So after you get the preliminary findings that you've agreed what to drop and what not to drop, I would expect then KRA would issue a demand notice, or what you call a formal assessment. I'm sure then from there, then the appeal, the objection process begins. So I would stop at that point, Joe, so that we can proceed with that part of the discussion.
Thank you, Anne. And maybe to ride on what you already shared, and Terry, you can give us your experience, whether you have encountered situations where letters of assessment are issued without actually KRA providing the preliminary findings to the taxpayer, and what recourse does the taxpayer have in that case?
Yes, Joe, there are instances where that can happen, but I must say increasingly you will find the tax authority issuing preliminary findings to the taxpayer in order to give an opportunity for clarification and engagement with the taxpayer before issuing a formal assessment. However, in the case where this is assessed automatically, and usually this is for issues that are quite clear in law, perhaps if I just give an example, you have submitted your payroll records and the tax authority has looked at this against your pay-as-you-earn filings and has found there was a discrepancy, then that may be assessed automatically by the tax authority. But in most cases, then you would find, and increasingly in more recent times, the Revenue Authority will issue preliminary findings in advance. In the case where an assessment is issued, the statutory timelines for responding to the objection would immediately start to count. That's a 30-day window, which again is guided by the Tax Procedures Act. So really the work a taxpayer can do at that point is review the letter in detail, try and engage with the tax authority office yet again, despite the fact that it's already a formal assessment, understand the basis for this assessment, and prepare a formal objection or a concession in the case where you agree with the KRA's findings.
Before we go to objection, maybe you can let us know what normally constitutes a valid notice of assessment. So what should a taxpayer expect to be the contents of that letter?
So a valid notice of assessment in the first place is raised, of course, by the KRA on formal KRA letterhead, and it's signed by the commissioner or deputy commissioner in charge of the department that was undertaking the audit. That letter must contain, and usually contains, details on the tax that has been assessed, the details of the adjustments that were made, if any. If it pertains to issues that pertain to interpretation of the law, it will go into detail to explain that as well. Further to that, then, it will calculate the principal taxes or revenue adjustment that has been made by the tax authority. It will also indicate the penalty that has been calculated on the underpaid tax or assessed tax. It would calculate the interest as well within that letter. It would indicate the due date for responding to that, which I did allude to is the 30 days to lodge an objection or concede to the assessment. But another critical thing that a valid notice of assessment must, I would say maybe contain, is that it must be raised on ITAX by the tax authority. Previously, KRA would have issued a letter, and that letter would be the main basis for the assessment, but now the two go hand in hand concurrently. Once a notice of assessment in form of a letter is issued, then the tax authority will also issue amended assessments or default assessments on your ITAX ledger automatically.
But maybe from my experience, once I encountered a situation where the assessment on paper, on letter, had varying amounts compared to the assessment that was raised on ITAX. What should carry the day in that case, and what should the taxpayer do?
Good question, Joe. Usually, the ITAX assessment will carry the day because that's the formal assessment that has been issued. However, just to address the issue here, yes, sometimes there are discrepancies between assessment letter and what has been raised on ITAX. But sometimes it even goes as far as noting mathematical inaccuracies in the KRA's calculations of an assessment. So it's very important, yet again, to review every single computation that the KRA has made, either in their letter or workings, as well as on ITAX, to make sure that this actually makes sense from a computation point of view. But again, there will be the opportunity to object if you find that there are errors or inaccuracies in this letter or on ITAX, or there is a discrepancy. So, Joe, not uncommon. It does happen, but really the ITAX assessment carries the day, but with the opportunity to actually raise this in your objection if you identify such discrepancy.
Back to Anne. Terry mentioned once you get the assessment, then you have room to object within 30 days or a day. Maybe you can paint a picture to us how a taxpayer is legally required to make the objection. And by so doing, maybe you can give us your experience in terms of why is it that there has been a number of cases where notices of objections have been ruled out as not having been validly filed. What would make an objection notice to be invalid? So you can just help us understand how a taxpayer is required to make an objection, and in so doing, how they are required to make it a valid objection. And
when now we kick into the objection stage, things become tight in terms of timelines. So this is why you need to really be very careful to note the date of the assessment letter, that you're able to count 30 days to ensure you don't miss out on the due date for the objection. So it should be within 30 days after you receive the assessment letter. Then the objection must be in writing, clearly indicating the grounds of objection. And then if there's tax that you concede to at the point of assessment, before you lodge the objection letter, you're supposed to pay the tax that is due. And if maybe you have cash flow issues, then you also need to engage with the commissioner to get you to a payment plan of the amount that you concede to pay. Then for a valid objection, again, documentation. I said documentation is very key. You have to support your arguments with clear documentation, data of high quality and integrity, so that then again, the objection can be admissible. And then what you've seen, again, maybe failing is that you do not follow the due process as per the requirement under the Tax Procedures Act. So there's a way you need to lay out your objection. You have to ensure it's concise, it's clear and precise. You may find an objection that is jabbled up, meaning things are all over. You cannot even be able to connect one point to the other. So it's important to research and see the best way to lay out an objection so that, again, it can be admitted by the KRA. So to be valid, it should be written, timely, clear ground of objection, proper documentation, and payment of tax that is not in dispute. Again, in case then you find that we are not able to object in time, then the law also allows for extension of time. So I think, Joe, for now I can stop at that point before we go to the issue of the application for late objections.
back to Terry, and we'll take one question from the audience and readers is, what happens when an obligation is not activated, for example, VAT, but in real sense you are in trading? Will the blame fall on the taxpayer? And how do I know the obligation I should have registered for based on the business of the company. So maybe with regard to VAT, Terry, you can help us clarify whether the requirement to register is purely on the taxpayer, and what happens if they meet the threshold and they have not registered for a while, and it happens that KRA catches up with them.
Actually, you've put it very well. So the burden to register for your tax obligation is solely on the taxpayer. And for VAT, it's quite clear that the annual turnover threshold for VAT registration is 5 million Kenya shillings. So as a taxpayer, when you do your projections or contracting with your customers, then you always need to have at the back of your mind the fact that if you have a VAT obligation, then you would be required to register once you hit that threshold. So it's advisable not to wait until you are at the 5 million point to start monitoring early so you can lodge your application. The Kenya Revenue Authority has increasingly, as we've all seen, undertaken a lot of scrutiny on VAT registered taxpayers due to offenses within that tax area. So typically then the process to VAT registration now takes a little longer than it used to. So in the event that then you're in trading and you have a VAT obligation and your registration is late, then the tax burden on that, or the late payment burden, which would be a penalty, would fall on the taxpayer.
Back to the objections, and still on you, Terry, you can paint us a picture after you've objected, how long you expect to get feedback from KRA, and in what form, and whether there will be discussions in between before KRA formally writes back to you as a taxpayer.
So once you've lodged an objection, as has been indicated, should be done within 30 days, and this has been received by the tax authority, then the commissioner has 60 days to issue an objection decision. Within these 60 days, it's a very critical time for the taxpayer to actually explore further engagement with the commissioner or the department within which the tax assessment has been issued. This objection will typically go to what we call the Independent Review of Objections Office, still situated within KRA, but mandated the authority to review objection notices with an independent mindset. So it would be a team that constitutes very different people from the assessing team. And this team would be tasked with looking at this objection and looking at the submissions made by the taxpayer and looking at them against the assessment that has been issued by the tax authority, and allowing the taxpayer to submit their submissions to the Independent Review Objections Office to consider. Again, just to emphasize, this is a critical stage in the dispute process, which begins with the raising of an assessment, because we have seen a lot of taxpayers actually get relief from a lot of taxes that have been issued at the assessment stage during this 60-day period, such that by the time the commissioner issues an objection decision within the 60 days that is allowed within the Tax Procedures Act, then this would provide more clarity and only confirm the issues or tax areas that are not disputed.
And Terry has mentioned that you expect to get feedback from the Revenue Authority within 60 days. Maybe you can clarify to us whether there are any situations that may make these 60 days to be varied.
We indicated that at times the commissioner may receive an objection that is not valid, and then they may request the taxpayer to lodge a valid objection. So that again interferes with the 60 days. So if in such a scenario, then the 60 days will start counting at the point now the taxpayer now is able to prepare and lodge a valid objection. So that is one of the scenarios that can lead to the extension of the 60 days.
And maybe another question that I would want to push back to you, Anne, is during this objection period, whether a taxpayer is allowed to provide any information that was not available during the audit and now has since been availed.
That's a good question. Of course, I know when you look at the law strictly, it's mentioned that if information was not provided at the objection stage, then it cannot be adduced later. But noting that we are talking of managing a process, that is the KRA audit. We've seen that the IRO team do agree to have a discussion with the taxpayers within the 60 days limit just to try and maybe understand the grounds further that are being cited by the taxpayer. At that point, it's possible to provide further clarification or further documentation just to support what the taxpayer argument is. So it's possible at that point, as you engage with the IRO, to provide further documentary evidence just to support your case.
And recently, I've seen that there was a new development in terms of what happens at the independent review of objections. And there was a notice published by Revenue Authority saying that the Customs Department has also set up their own independent review of objections office. And you can confirm whether from experience you've seen this being put into practice with regard to customs disputes.
I think they have seen it's a good practice because, as you said, this is the independent reviewer of objection. They're not really the assessing team, the guys who went to the field to conduct the audit. So I think it's a good practice for all taxes to ensure that matters are concluded on time and any tax that is due is paid within, again, a reasonable time. As you said, KRA is also pressed to collect taxes within some given timelines. Also, the taxpayer wants to conclude this matter as soon as possible. So if there are more avenues to engage and to collaborate, as I said, then it's a plus for both. So I'm not sure whether it really started off in terms of customs engaging with the taxpayer through IRO, but I would say it's a welcome move because, again, issues get to be understood better when people get on the table and discuss the matters further for clarity. So I think it's a welcome move from where I sit, and I know it is going to benefit the government as well as the taxpayers.
We've exhausted our discussion for today. Thank you, Anne. Thank you, Terry. And thank you, our audience.